Let's bring in Scott Wren, Wells Fargo Investment Institute Senior Global Market Strategist. Scott, good to see you. Today, clearly, some of those cyclical sectors, energy, financials, selling off pretty aggressively. What do you do with those sectors today?
Well, I tell you, well, they are selling off pretty aggressively. And what we've been telling our clients to do is look for opportunities. The four worst performing sectors today are ones where we are overweight. We're favorable on every one of them. And so we've been trying to encourage our clients to have a plan. Most of them have cash on the sidelines, not uncommon for retail investors these days. And to, step in on bad down days, bad down weeks. Because for us, Sarah mentioned 15%. We're not quite that optimistic by the end of the year, but 6% higher for the S&P 500 by the end of this year, and 15% by the year end 2022. So we are optimistic. We're going to get there with those cyclical names. We don't want our clients to hide, and so downside is opportunity right now in our minds.
You mentioned there that a lot of your clients have cash on the sidelines. To what extent relative to sort of historic levels?
Well, I would tell you that our clients, and this is going back for a number of years, they have not had generally, double, but they certainly had 10 to 20% more cash typically than what we've been recommending to them. And I think the reason for that is clients, particularly high net worth clients, retail clients, they tend to be older. They lived through the tech bubble. They lived through the financial crisis. They don't think they have time to make this money back anymore as when they were younger. And so they've been much more conservative. So there's a lot of fuel, and people would argue trillions on the sidelines that could go into the market, which is true. But in this particular cycle, I think you're probably going to see retail investors continue to sit on a lot of that cash just because they're concerned. They tend to be older. And that's been an issue really for a number of years now.
Scott, it's Sarah. Thanks for clarifying the 15% by the end of next year.
I wish we were that optimistic, Sarah, but if you're right, we'll take it. So.
Well, my question is, what about bonds? Are they going to interfere with your call? Yesterday, everyone was talking the taper. The Fed's talking taper now, and the Fed's going to pull back. And you like all these value and cyclical groups. And what's happening today? We're seeing some aggressive flattening of the yield curve, and technology is taking off.
We really are. I mean, growth is back today anyway. But for us, really, our call is for the end of this year. We'll see the 10-year yield at 2.25. I mean, that seems like a long way away now, but I do think that if we're going to grow 7% this year, which is our number, a little over 5% next year, is the 10-year yield going to be able to hold here at 1.5? We don't think so. We think it's going to work its way higher. It's a good sign. The bond market and the stock market are in a bit of a disconnect here lately. But for us, we do expect this stronger growth to last. We do expect rates to be higher. And let's face it, the Fed yesterday, they basically said they're going to raise rates in 2 years. It's not like they've taken their foot off the accelerator. The market knew that we're going to see some kind of tapering here. It could very well happen before the end of this year. But really the Fed, I mean, you can make a very rational argument that the Fed should be tapering and rates should not be at zero if we're going to grow at the rates that we think we are over the rest of this year and next year.
Is dollar strength going to continue, and is it a problem for U.S. equities?
Well, we thought we would get a little. Now, this was a big day, obviously, for the dollar index. We thought we might see the dollar drift a little higher until Europe and some of the rest of the developed world gets their act together with these vaccines. We know that the UK is seeing some more lockdowns, some other countries. But we think by the end of the year and when you move into 2022, that the European economy, the Eurozone, the EU is going to be doing considerably better. Those interest rate differentials should narrow in favor of Europe. So we do see some modest fall in the dollar index. Let's say by the end of next year, we're somewhere mid to maybe slightly upper 80s on the dollar index from the 91 level we're approximately at right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.